Hi, this is T from Digreshka.com. This video will be dealing about put calendars, also called time or horizontal spreads. Put calendars are market neutral debit trades. Depending on where you center your strike, you can eventually adjust your outlook to be a little bit more bearish or bullish. This is usually done by selling or shorting a put option at the money or close at the money nearer to expiration, and buying a put with that same strike but only with a later expiration date as the hedge. With this trade, you expect that price more or less stays around your strike area during your holding period, that is until expiry or until you sell the combo. You capitalize on two factors. One, on the time decay of the front month option, and two, the IV expansion of the option. All other factors remaining constant, the front month option has a higher theta factor and will get cheaper, allowing you to sell the combo for a higher price. IV expansion implies an increased uncertainty priced in the option and hence adds to the value of your options. This is a net debit strategy. The goal is still buying low and selling high. You sell higher when IV makes the combo more expensive or when the short option is worth much less than before, and that will be the key to success in using this strategy. Your max loss is the cost of your combo. And the break-even points, well, the break-even points are a little bit difficult to calculate as to the strike price, in the sense that having a net debit strategy that earns from theta decay of the front month option sold. Two things to remember while the calendar is still intact: that your profit is limited to the premium of the sold front month option, and that your loss is limited to the price you paid. An interesting point of view here is that you in effect purchase the back month put position by selling an option with the same strike only closer to expiry. Bear in mind that in the long term, this is a bearish strategy. Some traders do calendar puts to let the front option expire and let the back option run at a cheaper cost basis, betting on a downward movement. Calendars are best used on a low IV environment in anticipation of IV expansion. When IV expands, it's also interesting to know that the theta decay of the short put increases even more. Don't forget, changes in underlying price and IV have great effect on the profitability of this strategy. If the IV of the options expand, you increase your chance of selling your combo for a higher price. It's also most favorable that the stock price stays close to the center of your strike before expiry of the front option prior to closing out the combo. This strategy is suited for smaller trading accounts. There is no margin required. But interestingly, this is a debit strategy with the advantage earning on theta or time decay, which is commonly an advantage only for net credit strategies.